Welcome to the Werthstein Index Update March. Powell, protectionism and high prices for shares. These three Ps probably best describe the mix of negative factors now keeping stock markets in check. Everything went according to plan after the slide 4 weeks ago. The hot tempers cooled off a bit, valuations came down a bit, and stock markets recovered at least a bit. But now these three bits seem to lead to a second cold shower in what feels like an uncomfortable year for stock markets. So let's see how the experts of the Werthstein Institute assess the situation.
P for Powell, the new chairman of the Federal Reserve. Will he really raise interest rates 4 times this year? P for protectionism. Will US President Donald Trump raise tariffs and risk a trade war with the rest of the world? And P for prices. Markets are still skating on ice. True, the economy is growing and corporate profits are rising. But does that alone justify the historically high prices on the stock market?
I want to pass this question on to Giles Keating, president of the Werthstein Institute in London. Giles, where are we currently in terms of valuations?
Well, valuations are not at all-time highs, but they are definitely at a high level compared to history. And that does sound a note of caution, especially at a time when, yes, economic growth is pretty good around the world, but some of the latest data have just been a little bit mixed. On top of all of that, you've got interest rates rising, of course, and the price action since that February sell-off really hasn't been very convincing.
Speaking of recovery, the technology stocks were at the forefront here, especially the FANG stocks, that's Facebook, Amazon, Netflix and Google. When we take a look at the chart, we see that these values are now even higher than before the mini crash in early February. What does that mean?
Says a lot of money has flowed back into those stocks. I think a bit too much. Of course, they do represent the economy of the future, but I think their business models are going to come under challenge, both from competitors. I think, for example, Microsoft is now really trying to challenge Google when it comes to search, and from regulators as well. So I think there could be a bit of trouble ahead.
And now we have to talk about America first and protectionism. What is the danger of a trade war and what are the consequences?
When Donald Trump was elected, investors were very worried about protectionism. The threat seemed to go away, but now it is clearly right back on the agenda. It's not a one-way street. A lot of people, for example, in Congress and US business are fighting against it, but still the risk has gone up. It's another danger for investors.
What does it mean for your weighting in the Werthstein Index, where the 1 stands for extremely negative and the 10 for extremely positive regarding the stock markets?
If I draw it all together, there's definitely been an increase in risk here. So I come down from a 5 to a 4. That's not yet in a red territory, but I'm no longer anywhere near green. I'd really say I'm fairly amber.
And to Robert Halver of the Bader Bank in Frankfurt. Robert, let's talk about the P like Powell. Suddenly, number 4 of rate hikes seem to occur. The new US Fed chief has not calmed the markets, to put it mildly.
I'm not afraid of Powell either. It was the first appearance of the new chairman of the Fed before Congress, and on his first appearance he'd never say what he really thought. Incidentally, we're not afraid of inflation, because globalization and digitization are constants. There's no inflationary pressure and hence no strong trend to raise interest rates. There's another word I'm much more afraid of, tariffs. Tariffs, they cut to the bone. They destroy the global economy, and above all, they destroy the German and European economies. That's by far the bigger issue. Interest rates are nothing.
Giles voted with a 4. You went down to 6 4 weeks ago. How is your conclusion for the overall markets this time?
This time I'm going for a 7. Why? First, I'm not afraid of rising interest rates. We simply can't afford them anymore. The world's insolvent and there's no great inflationary pressure. Second, I take the tariffs issue seriously, but we must wait and see what actually happens. At the moment, Trump is campaigning for the 2018 midterm elections. I wonder if he'll keep this tariffs idea going, but I don't think so, and that's why I'm optimistic.
Many thanks. We'll see more from Robert at the next Werthstein webinar on Wednesday, March 14th at 6 p.m. Together with Stefan Risse, Robert Halver will discuss the current market situation and answer your questions. We'll also show you how Werthstein's digital asset management works, so you can start right away and put together your portfolio. So let's get a quick estimate of the market from Paris from Valerie Plagnol.
The correction in the market earlier this year has been almost completely reversed. In the meantime, most recent economic data, both in Europe and in China, seem to indicate that we have reached a peak sometime earlier this year. So this doesn't mean that we're heading for a recession, but I believe that at these levels, profit expectations are excessive. So I still look to take some profits and probably wait for another bump down the road. In this context, I keep my vote down to 1.
And now I welcome Stefan Keitel, CEO of Deka Investment. Hello, Mr. Keitel.
My pleasure.
You are responsible for the investment strategy at Deka. How are you currently positioned?
This depends a bit on the time horizon we talk about. And from a longer-term perspective, fairly constructive. And this has to do with the so-called Goldilocks scenario, meaning we have a quite strong macroeconomic environment across the globe, and we have a still moderate inflation pillar. And this is a quite healthy situation for the capital markets from a longer-term perspective. In addition to that, the fundamentals out of the corporate's earnings camp are also pretty constructive over the last quarters, and we don't expect a turnaround over the next ones. And this in combination with the lack of alternatives we are still confronted with, it's a fairly constructive picture for the medium to long-term horizon.
So in the short term, further turbulences can be ruled out?
That's right. We strongly expect quite vulnerable markets over the next weeks and months, and we already experienced the first correction wave, very much driven by some interest and yield fears. And in addition to that, we should not underestimate that there will be some discussion ongoing out of Italy, there will be some discussion ongoing out of the Brexit topic, and there will be some ongoing discussion with regard to the Trump policies. And this all together delivers a picture where we have to say that in 2018 markets will be more vulnerable compared to 2017 and will show much more volatility.
Let's take a look at the current index for the month of March.
Valerie Plagnol stays on 1. Robert Halver goes up 1 point from 6 to 7, and Giles Keating lowers his rating from 5 to 4. The Werthstein Index is the average of all 3 valuations, and thus in March it stands at 4.0, the same as in February.
Werthstein has been warning for some months that 2018 would be an uncomfortable year for stock markets, and the last few weeks have confirmed that prediction. So alongside those negative 3 P's, we could add another P, as in patience for shareholders. The share prices fluctuate, but they still belong in every portfolio. We will get back to you in our next assessment in 4 weeks. Have a good time.